Take a look at some of the market action as we always do. We're 90 minutes into the trading day. Stocks rising on the first trading day of 2025. Joining me now, we've got Brian Mulberry, who is the Zacks Investment Management Client Portfolio Manager. Great to have you here with us, and Happy New Year to you, Brian. You say 2025 is going to be a, quote, normal year for the market. So what does normal mean in your purview?
Well, kind of going back to returns on the market in line with earnings growth. What we've seen over the last 2 years is the S&P 500 up more than 20%. So you're roughly 45% growth over the last 2 years. That's happened only just a few times in history. Most recently, about 30 years ago. It doesn't tend to grow at 20% a clip every year. And so what we have is a lot of the price action already built in to the level of the market where we are just under 6,000 on the S&P 500. So what that means is, while we expect a good year for earnings growth up around 14%, we only expect muted returns, maybe an 8 to 10% positive year, which is certainly not bad. It keeps the momentum going. We're talking about all good things. It's just difficult sometimes for investors because they get lulled into that false sense of security. I'm going to get 20 to 25% every year out of the S&P 500. That is the anomaly. What we do expect is more of an 8 to 10% type of year, which we would simply call normal. And that might be a little bit boring, but it still means good news for markets.
Yeah, Brian, what's the earnings growth profile that you would be looking for in that instance? Because as I was taking a look at some FactSet data before we went to air, S&P 500 calendar year 2025 earnings preview that they put out saying that their analysts are expecting earnings growth of 15%. What could that earnings growth look like in your best estimation, and how does that kind of flow through to the market performance?
Yeah, so what we see is the top end of earnings growth in the S&P 500 at roughly $280 per share by the end of this year. That would be in line with that 14 to 15% growth rate that you're talking about. The problem is about 70% of that growth is coming from the Magnificent Seven stocks. And so to have such a concentration of earnings growth from so few names is something just simply to be aware of. The good news is the Magnificent Seven stocks are very profitable companies with wide moats and very strong cash positions. Those are all good things. But what it means is the contribution of growth coming from so few names is there's a risk to any disappointment, just like what we're seeing with Tesla today. Any type of disruption in that momentum is going to have an outsized impact in terms of volatility. So what we could see, while we have more of a normal return structure, is probably higher volatility in 2025 because the concentration in earnings is coming from so few names. So put it a different way, if we take out the Magnificent Seven from that earnings projection, earnings growth goes down to roughly 4, 5, or 6% in the S&P rather than the 14 or 15% that you get by including them.
Which sectors do you think present the largest opportunity then?
Well, some that are a little bit, I think, out of favor. Obviously, technology, AI momentum is real. There's going to be a lot of excitement there. So looking outside of that particular sector, looking at financials, what we see as an opportunity for perhaps deregulation, inviting more activity in terms of mergers, acquisitions, and IPOs, things that we simply haven't seen much of over the last 2 to 3 years. We also believe staples could be a great way to be a little bit more defensive. It's a little boring, but we're seeing very high quality structures in terms of growth from Walmart and Home Depot, places where you can kind of hide out in some of these more volatile quarters in the next probably 2 to 3 quarters that we're expecting. And then durables. We're talking about investments in growing the power grid. We think there's also going to be other infrastructure investments in terms of roads and bridges and other infrastructure spending deals, both public and private. And so there's going to be areas there where you can find very high quality companies, very strong, durable earnings growth structures, and a way to invest your portfolio that's going to be a little bit defensive, because again, we do expect some volatility over the next couple of quarters until we get a stronger footing for that growth to kick in the back half of this year.